Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
We are going to talk about portable mortgages. We'll discuss what they are, how they might be used, if other countries are doing them, the benefits, the drawbacks, and everything you need to know. This is all stemmed from, of course, you know about the 50-year mortgage. We just did a video on that. So this is a new thing. Trump administration is evaluating portable mortgages. What that means for homeowners. First of all, Juana, is this something the executive branch can just do on their own? Can they just say, we're just going to make this thing and everyone has to do it?
No, I mean, best case scenario is going to take a couple of years and one election cycle. So, because remember that the president can say, hey, I would like to do this, but it's up to Congress to make this thing happen.
Okay, it does. And it also takes...
Okay, so I'm going to put a caveat with that.
Yeah.
That is, if this is going to be widespread. Now, can a local bank do that? Perhaps. A local lender might be able to do it. A private lender might be able to do it. But if it's going to be at scale, then we need congressional involvement.
Okay, and this has to do with mortgage-backed securities. Here is a quote from the article. Moving the portability legislation through Congress might take a year or two, and only if there is bipartisan support for such a measure, which there probably won't be. Additionally, the impact on mortgage-backed security markets would need to be considered, as homeowners would be allowed to hold a low-interest mortgage for decades. Juana, what does this mean, portable mortgage?
So I live in this house, I have a mortgage, and I want to buy the house across whatever, and I'm going to take my loan with me. So let's say, for the sake of argument, I owe $1 million on this house. And I'm going to go down the road and I'm going to go buy a house that's maybe 1.5 million. Okay. Because most of us tend to move up. So maybe I'm going to go down and buy a $1.5 million house. Now I'm going to take my $1 million loan across the way and attach it to the new house. And then I have to come up with the difference, that $500,000 difference, to make that seller whole. Now, in order for me to do that, can I talk about that?
Yeah. Sure.
Okay. In order for me to do that, I'm going to have to do a few things. First of all, I'm going to have to re-qualify for my $1 million loan. And there will be appraisals, there will be documents to be turned over, there will be fees, and all of this takes time. It takes a little bit longer generally than maybe a regular loan origination where I'm buying a house and getting a new loan. So it is more complicated, but the bottom line is I will be able to take my loan that is at 1% interest and put it now on this other house. This would be great. Right?
Right, and that's a function of risk, right? They don't want you to just the loan is tied to the house because of risk, and if you default on it, they can just sell the house and get the money back. They want to make sure that the other house you're buying is in a similar situation. You don't have a bunch of senior deeds on it to their loan that all of a sudden, if you got foreclosed, they couldn't get all their money back, right?
Right.
So this is all about risk.
Right, and then also that I can still manage this sort of debt and debt repayment, because remember, I have to re-qualify for it.
What two countries right now have this in a limited form?
So the UK has it, and our neighbors to the north, Canada has...
The 51st state.
Right. So Canada also has it. So theirs are different than the way we do loans here, right?
Right.
Okay. So we start with probably the most important thing to remember is that our loans, when you take out a 30-year loan, how long do you have to pay it back? 30 years, right? Okay. Now in Canada or the UK, your loan payment is spread out over a 30-year period. That's called the amortization.
Amortization.
However, your loan actually has a balloon after anywhere between 2 or 5 years. Canada, it's up to 10 years. That means that loan has to be paid back in full by that maturization date. And so what does that mean? Well, it means that when your loan matures, you have to do one of two things. One, pay it off, or two, refinance it again. Right? If you're still in the house and you're not able to pay off the loan, you're going to have to refinance again. So the reason portability works is because they have these shorter terms, right? So they can... That risk model, that interest rate risk model, is for a lot shorter term, so they can offer that. While in the US, we don't have that. It's 30 years. That's how long you can keep that loan for. You don't generally have balloon unless you have another funky loan product, maybe something with a balloon or whatever else other strange loan product you might have. Not one that most people would be familiar with.
If let's say the going rate's 5% for a 30-year fixed, and they pass this legislation, is the mortgage industry going to be keen on you just being able to hang on to that 5% rate? Because remember, if interest rates go up, you just keep the rate. And if interest rates drop, you sell the house, extinguish the loan, and you borrow money at a cheaper rate. You do like a refinance, right?
Right. But, look, it's like any other loan product. So let me give you an example, Todd.
Okay.
So let's say, that the going rate is 5%. Well, is it 5% for all loans? Of course not. It's 5% for the Goldilocks loan. What does that look like?
Well, I'm just using the number as a base mark because I have a follow-on question.
Right. But what I'm saying is, so maybe that 5% is for a conventional loan that is a 30-year loan. But if you get a 15-year conventional loan, maybe that would be 4.5. Maybe if you get a 30-year FHA loan, maybe that's 5.5. So it varies. So when you throw in this portable loan product into the mix, it's going to be the same thing. It's not going to have the same that Goldilocks interest rate. It's going to be at a higher interest rate because of what's happening.
That's what I was trying to get at. So, you're not going to get the smoke and deal rate magically. You can just, because there's a lot of people out there. Like the idea behind this was we need to unlock housing. Like we need more incentives for people to go out and transact in the housing market. And so what they're saying is, well, if we can get people to give up, no one wants to give up their 2.5% loans. Well, if we allow that 2.5% mortgage, them just to take it with them to the next house, because they don't want to get rid of their extinguish their 2.5 and go pay right now, which is about 6.25, a little over 6%. They don't want to have to give that up. So they're saying, I'm staying put. They're like, well, we can unlock housing and just have more houses be able to transact so more people can buy and sell. But there's a problem with that because this would only affect new loans being originated. They wouldn't be able to go back retroactively and say, okay, your loan you can take with you because that loan was sold into some pool of mortgage-backed securities. Right.
So just like you can't arbitrarily say, well, my 30-year FHA loan is now a 15-year conventional loan, right? You can't do that. Your loan is your loan. It's the same thing with this. These would be new loans that are newly originated. Now, what I want to point out is that the reason that the UK and Canada have these portable loans is because there was a need for people to be able to take their loans with them because these loans have a prepayment penalty, something that we generally do not have on our loans here in the U.S.
I don't think they're allowed now, are they?
So
on residential properties.
I don't believe that they are.
Yeah.
So generally speaking, we do not have prepayment penalties on our loans, so we don't need to take the loan with us in order to not incur that prepayment penalty. That's the reason why they have these portable loans, so they can avoid those prepayment penalties.
They also have this disconnect between amortization schedule, meaning you make payments as if you're paying off the loan for 30 years or 25 years, and then you only have like a 3 or 5 year product, meaning you have to refi that loan. So that's how the banks, if it's a small bank, they deal with interest rate risk. If interest rates are going up, you can't just go, hey, I got this super low loan, I'm locked in. What happens is they say, hey, your loan's due in full, but we'll refinance for you at the current rate of 6% instead of what you were at before, which maybe was 3%.
Right. The other thing is not only are they able to refinance for you, but of course, we all know that no service comes without fees.
Okay.
So of course, you're going to have to requalify for that refinance. There probably was going to be a new appraisal, new fees. So all of that drama starts all over again. So if you've been through it recently, you know what I'm talking about. You probably don't want to do that every 2 to 5 years. So that's something to keep in mind.
We have probably the cleanest system for mortgages in the world for home buying. We've made it super easy for average people to buy houses. Most people in the world do not have what we have. When you see something like Croatia has 92% home ownership, where they own their homes free and clear, that's fake. They were all, when Yugoslavia failed and communism failed and the country was split into different, Yugoslavia split back into its original countries, whoever you were living, you were basically granted, the government granted. So whoever took over Croatia said, hey, wherever you live, it's yours. Like, we don't want it. The state used to own it, but now you only have basically title rights to it. You can sell it, you can do whatever you want with it. So everyone's homeowner, but it's not really because they just had a communist system that failed.
Well, yes. I mean, in some cases, they did pay some amount of money for him, but that's really beside the point.
Is that what they did in Romania?
Yes.
Okay.
But so that's really beside the point. So kind of staying focused on this. So this portable loan product, it's just another product. Is it possible that it'll come to the US? Sure, anything's possible. It's just another loan product. Can it be securitized and sold? Yes. So all of these things can happen. It does take amending our laws for that to happen in order for it to happen broadly. And that's what I was saying at the beginning, that this is probably going to take a couple of years because it's probably going to have to go through an election cycle. Nothing moves quickly. And to Todd's point, the U.S. does have the cleanest and easiest system for home ownership. But as we know, the market is efficient, and if there is a need for this product will probably have the opportunity to see the light of day.
I think this is what I would do. I would basically ditch this portable loan thing because to me it's gimmicky, right?
Okay.
I would create a loan product where you get, the loan is only in place for 15 years. After 15 years, 10 or 15, somewhere between 10 and 15 years, you have to refi it. However, I would amortize it on a 50-year profile. So I'd say, look, it's a 50-year amortization schedule, but in 10, 15 years, when instead of being $500,000, it's $300,000 that you owe, you then have to refinance it on a standard like 15 or 30-year amortization and a full loan. Like you could do it once when you first buy the house. You can buy this 15-year thing with a 50-year amortization. You're making smaller payments, but then at some point you actually have to do a refi. Commercial actually works this way. When you go buy a commercial building and you get a loan, that loan's only good for 5 years. They call it a balloon payment, but nobody actually pays the full amount. I mean, some people do pay the full amount, but most people just keep refining it every 5 years. And then you have a problem that we have now when interest rates were low and now they're high, and you're refining this amount at a higher rate. A lot of times doesn't make sense because the building doesn't generate enough revenue to cover your new higher rates.
So I think that there's a lot of chatter about ways to make homeownership more affordable, and I think everybody's got their own ideas out there as to what's going to move the needle. To me, at the end of the day, it's less about these ways to finance homes, and it's more about building enough homes so that there is a better balance between supply and demand, and that takes care of a lot of different things. Also, the economy being robust and people working and having income, that's also helpful as far as being able to afford homes. I think all those things combined are probably a better solution long-term rather than gimmicky things like a 50-year or portability or anything like that. I don't think that those are the panacea that people make them out to be. I think that they should be heard. I think they should be debated because they certainly have sufficient merit to be discussed. I think at the end of the day, even if they are legitimized in the U.S. market and they are actual products that people can use, I think the number of people that would actually participate in those products would not be as great as maybe people estimate.
There are a lot of super cheap homes in the U.S. They are just not necessarily in places people want to live.
They're not in places people want to live because of economic opportunities, and they're not in places people want to live because of desirability as far as maybe schools or other amenities that are important to them.
Yeah, weather.
Okay.
All right.
So hopefully this was kind of fun and interesting for you guys. Please remember to leave us comments, whatever you've seen or heard or read about this subject. It's always interesting to us. If you are a Canadian and you have a portable mortgage or you've had experience with portable mortgages, please leave us comments. Same thing if you're from the UK and watching, thank you and welcome. Please leave us your experience because we're kind of looking at it from the outside in, and it would be lovely to hear from somebody who's actually had firsthand experience with these loan products. Please remember to like the video, subscribe, hit the notification bell, share the video, and we'll see you on the next video. Bye.
Bye.